In this video, I want to highlight how currency fluctuations impact global stock prices. How currency fluctuations impacts global stock prices. Currency fluctuations can be, it can have a significant impact on global stock prices. When currencies experience change in value relative to one another, it affects both domestic and international markets. So here is how these fluctuations influence stock prices. Number one is effects on corporate earnings. Effects on corporate earnings. So currency fluctuations can influence the profitability of multinational companies. For example, appreciation of a domestic currency. Appreciation of a domestic currency. So when a country's currency strengthens, its goods and services become more expensive for foreign buyers. So this can hurt the earning of companies that on exports, rely on exports, as their product becomes it becomes less competitive in international markets. The stronger the domestic currency, the less competitive they are. The companies operating in that country, the less competitive they are in the global sphere. And so you have depreciation of domestic currency. When the currency weakens, it becomes, it benefits exporters by making their product cheaper for foreign consumers, potentially boosting sales and profits. However, companies that rely on importing goods may face higher cost. And higher costs, we all know, will then reduce profit margin. Number two is investor sentiment. Investor sentiment. So currency fluctuations often influence investor confidence. For example, when you consider a strong currency may signal a healthy economy, leading to increased investor confidence, which can boost stock prices. So when you consider a weak currency, a weakening currency can suggest economic instability or high inflation, which may reduce investor confidence and negative impact on stock prices. Number three, impact on foreign investments. Impact on foreign investments. Currency changes can affect the returns of foreign investments. If an investor holds stocks in a foreign market, currency fluctuation may impact the value of their returns when converted back into their home currency. So appreciating currency. Appreciating currency. If the home currency, strengthen relative to the foreign currency, the value of foreign investment may decline when converted. In the case of depreciating currency, if the home currency weakens, the value of foreign investment may rise when converted back to their home currency. Number four, central bank policies. Central bank policies. So in this case, it incorporates interest rate changes. Interest rate changes. So higher interest rate can attract foreign capital, strengthening the domestic currency and potentially impacting stock prices by affecting corporate profits and investment flow. So usually when the central bank sets, exchange rate very high, it will affect borrowing both, at the corporate and the individual level. And so once borrowing is restricted, you discover that consumers will not have spending power and company will not really have the fund to expand. and that would trigger a drop in stock price. So quantitative easing, central bank may devalue their currency through policies like quantitative easing, which could make export more competitive but may hurt domestic stock markets if inflationary pressure rises. The central bank may choose to devalue the currency. You want this currency devaluation, and when you export items, you make more money, but when you import items, you have to spend more money. So either way, depending on which part of the trade you are. Before then, please like this video and subscribe to this channel. That would really motivate me to continue providing contents of this nature to you. Number 5 is commodity prices. Many commodities such as oil, gold, and metals are priced in US dollars, and so currency fluctuations, particularly changes in the value of the US dollars, can affect commodity prices. For example, in the case where you have a strong dollar, when the dollar strengthens against other currencies, so a stronger dollar can make commodities more expensive for foreign buyers, particularly reducing demands and affecting stock prices of commodity producing companies. That's the impact of a strong dollar. Then for a weak dollar, a weaker dollar may increase demand for commodities, rising prices and benefiting stock of companies in the commodity sector. Number 6 is emerging markets. Emerging markets. So emerging market stocks are especially sensitive to currency fluctuations. A strong US dollar, for example, can make it more expensive for emerging market countries to service their dollar-dominated debts, potentially leading to economic instability and negative impact on stock prices. Companies that borrowed money internationally discover that when they are paying back, considering the current exchange rate, they may end up making foreign currency losses, making losses due to the debts they incurred in foreign currencies. Then in conclusion, currency fluctuations can have a broad impact on global stock prices by affecting corporate earnings, investor sentiments, foreign investments, and commodity prices, as well as economic environment. So the currency will go a long way determining stock market activity, stock market behavior, and stock price movement is something worth considering as an investor.